All right, welcome everybody. I know folks are just trickling in. My name is Andrew Oddo. I'll be one of your hosts today from SVB here. For those of you who are just joining, we are going to be talking about the state of U.S. early stage venture and startups in our latest report between SVB and AngelList this past quarter. So very excited. I know we have a big audience, so we're going to let everybody get settled in. If you're new to SVB webinars, this is one of many we do. So Bo and I actually just did one yesterday on how to fundraise for your company. It's a very fun and exciting time to do that. I think especially with Q4. There's all sorts of stuff going on with hiring right now. We're going to touch on that. So we do webinars on how to get your company ramped up, how to put that funding to use right after you get funded by these VCs. So be sure to check out some of our other webinars, but we appreciate you joining for this one today. Let's go ahead and I'd say move to our housekeeping slide here. So just a few heads up, all of the lines have been placed on mute to prevent background noise. We are going to try and keep this as interactive as possible in our virtual environment here. So please feel free to submit your questions. We've taken note of a lot of the questions that were submitted ahead of time. So thank you for doing that. To turn off the closed captioning feature, you can click the live transcript button on the bottom of the Zoom bar. We're going to send a link to this recording after the webinar. Going to do our very best to answer as many questions as we can. In the event that we don't get to those questions, feel free to follow us on social media, connect with us via email afterwards. We are going to try and cover everything today. Next slide, please. So let's take a moment to introduce ourselves. Why are we at all qualified, right, to talk on the state of the markets? I'll introduce myself. So my name is Andrew Oddo, as I mentioned. I work alongside Bo, leading our startup banking practice here in New York City at SVB. We work with tens of thousands of founders. We work with approximately 50% of all those who are VC backed. And so I really love that we've taken AngelList's unique data set and perspectives and ours and put them together for today. I focus a lot of my time on helping VCs and founders meet each other and fundraise and to prepare to go out there and get your business started. So that is a bit on me. Abe, I will turn it over to you.
Good morning, everyone from San Francisco. I'm Abe Othman. I started the data science team at AngelList. I have started 2 venture-backed startups and have been doing early stage investing personally since 2015. And really excited to share the insights that we have from AngelList data this morning with everybody. Bo?
Hi, my name is Bo, and I joined Andrew's team recently to help support our early stage startups in New York. My background is in operating and investing. I've leveraged over a decade of consumer product experience. I really love helping our founders find early product market fit, one-on-one advisory, and fundraising strategies. So super excited to be here, and let's dive into the meat of the content.
And just a couple quick notes on our SVB Angels partnership here. So I'm pumped about today because I really truly believe that you have 2 unique data sets and mindsets coming together that you really can't get anywhere else. On the SVB side, as I mentioned, we work with tens of thousands of founders, 50% of those who are VC backed, but we also work with a lot of the VCs that invest in these founders. So we're going to dive into some really cool data today on how capital is flowing through the ecosystem, what founders are spending money on, how they're hiring, and more. And then we match up with AngelList, right, who has an amazing amount of things going on that Abe's going to tell you about, from founders going to the platform to meet investors to new investors launching rolling funds and so much more that AngelList has been doing over the last year. I'm sure I left out a million things that Abe can mention, but you really have tens of thousands of unique data points, stories, and things coming together here to kind of tell the in-between the line story of how investments are happening and to hopefully guide you all on the line today, right, to make better investing decisions or to raise and operate your businesses in a better way. So that's a bit of what we're going to discuss. Abe, I don't know if I missed any cool highlights on things that AngelList is up to these days, but I wanted to turn it over to you to tell us.
Sure. So yeah, thanks, Andrew. Yeah, one of the things that most excites me about working together with SVB is that both AngelList and SVB bring a real breadth of market understanding of the early stage venture capital market. That's super important when we talk about early stage investing, because it's not like there's some unbelievably reliable master list of every venture backed or venture backable startup that gets founded every year that gets written down somewhere. The early stage ecosystem and just in general kind of ethos is very nebulous, right? These are a lot of very early stage nascent companies, and reporting on them can be very difficult because you may not even know they exist. And so the breadth of data that both SVB and AngelList bring is really awesome. So from AngelList side, last year in 2020, for the first time, AngelList, the funds and syndicates on the AngelList platform participated in more than half of top tier early stage US venture capital deals. And we believe that number will be even higher according to kind of recent returns for 2021. So just an incredible amount of breadth that we see. And the other component that we're starting to get data on that I'm happy to share on is our new AngelList Stack product, right? AngelList is now focused on creating more and more products directly for founders and startups. So we will start to see some of the data from those as well, especially when you think about roll-up vehicles are another thing that are going to be tracked in our data set here and produce summary statistics on. So I think there's a lot of power from both SVB side and AngelList side in taking this huge massive data and coming up with like really interesting summary statistics from it. So really excited to share that today.
And the last thing I'll say there too is that this is one of a series of data sets we put out there. So be sure to see how this stuff is evolving and changing over time. Let's head to, the slides dropped off my screen. Let's head to the next slide though, if we can, for our SVB team. You might have lost the team here. Brian or Megan, are we able to get the slides back up?
Yep, it'll take just 1 minute if you sit tight.
Okay, all good.
Power was lost.
So I think one of the most amazing things we've seen that I know Abe's going to get into and that folks are always curious about is just how insane the valuations are and how they're changing, right? And so it's a really incredible time to raise. Round sizes are condensing, valuations are going up. I think this is changing how companies are operating. And I'll throw out a couple of facts that I have burned into my brain that Abe will kind of drift off of here. For starters, we saw in the middle of the pandemic when we were at SVB that companies on average, right, the time length of runway and cash that they were keeping on hand had blown up a bit. They had raised that to 24 months, 36 months. As the pandemic ended, they actually condensed that cash and that runway as well. And so you could see companies starting to hire again, deploy again, raise again. And that's something that the data is going to tell us today. And I think for those founders on the line who are thinking about raising and how to execute that, that's part of the narrative, right? You're deploying capital quicker and you're trying to be more efficient with that right now. And that's a big thing that's changed. Abe, I don't know if you want to speak to some of the facts we have on the surge continue slide. I have them right in front of me if you want me to tee them up for you.
Yeah, I'd be happy to kind of talk through that. So I think the real story that we've seen, the second quarter of last year was at least from AngelList perspective, the worst one that we had on record for early stage venture capital. A huge pullback, a lot of folks raising money at what we called kind of soft down rounds. So maybe no change in headline valuations, but some additional dilution with that lowered price per share. A lot of founders kind of battening down the hatches and preparing and extending runway. What we've seen since then is, truly remarkable, right? Activity recovered in the third quarter of last year. And then actually in the fourth quarter of last year, we saw for the first time 80% of startups that had changes in their price per share actually were marked up. And that was a new record, going back to 2015 of data that we track on the AngelList platform. What's more remarkable then is that record got broken in the first quarter of this year and the second quarter of this year. First quarter, that number was 85%. Second quarter was almost 90%, which is truly remarkable. The third quarter fell just short of setting a new record. We saw about 87% of the events of the startups that changed valuation had their price per share increased. We also found that the average valuation for startups was higher than they were in the second quarter of last year, and that startups are raising larger rounds earlier in the life cycle. Some of the individual kind of data points that we saw in our data as well from the third quarter, that a huge fraction of our activity in the third quarter was blockchain and crypto companies. We also saw on AngelList, a statistic that we recently started tracking, female founders on our platform in the first half of 2021 far exceeded kind of past historic industry-wide averages. I think it kind of remains to be seen whether or not that reflects kind of an Angel specific thing or a more general change in terms of the makeup of who's starting companies in 2021. And yeah, so this is not for, for the first time in 3 quarters from Angel's perspective, this is the first time that we're not able to say that this quarter is a record-breaking quarter, but activity remains extremely elevated and very high. This is the second best quarter we have on record. Was the third quarter. I don't know if Andrew or Bo, you have more comments kind of along those lines in terms of what you're seeing at SVB.
Bo, any commentary you want to throw in there?
Yeah, I think to add to that is just the pace of fundraising is also picking up. We're seeing a lot more preempted Series A, B, and C rounds. There's definitely a lot of dry powder right now for founders, and it's a great time to be fundraising, especially when geo and kind of the Zoomification of the world has become so widespread and prevalent.
Head to the next slide.
Cool. So this is the way that this is kind of my preferred way of interpreting kind of the Angelus summary statistics on the data here. So I'm just going to talk through these 2 charts. Time here is going left to right. So you can see 2016, 2017, 2018. What these statistics show is a trailing 3-month summary of the changes in price per share that we see of every startup that we have a seasoned investment into, every active startup that we have a seasoned investment into on the Angelus platform, which means that at the start of the 3-month period, we had an investment that was at least 6 months old. And that's just because we don't expect investments to change their price that quickly, especially for the early stage markets. If you think about it, there's kind of 3 things that can happen in any 3-month interval around a startup's price per share. The thing that happens most of the time, and in fact, happened about 89% of the time in the third quarter, is that nothing happens to the price per share, right? The company doesn't do another priced fundraise, so nothing happens. The 2 other things that can happen is the price per share goes up or the price per share goes down. And among those, that price per share going up or down can be a reflection of either a exit or a priced equity round. Angelus does not track safes or non-equity fundraisers or valuations in terms of the valuations that we consider, only priced equity rounds. So again, here time is going from left to right. You can see the good events here on the top plot. The good events are in orange and the bad events are in purple. So like markups are in orange, markdowns are in purple. The dotted black line there, it represents the median event. So it's essentially like as that line goes up, the thing that happened to a typical startup gets better and better. And what you can see from kind of tracking this plot is it really reached a trough, right around the start of summer last year in 2020. That was kind of a record low median event. And then since then, that value has more or less been on a straight upward trajectory, straight climb up to where we are today. The bottom plot is another slice of the data that doesn't track activity tenor, but instead tracks activity type. So both activity, meaning a change in price per share, as well as like what fraction of that activity were exits. So I think what you see here is kind of a general decrease in the frequency of exits, although exits are fairly rare in any 3-month period. You really don't expect the startup to exit. But activity rates, which again reached a trough last year, are now on the rise again. The most remarkable statistic is that if you look at it, of the startups that changed their price per share in the third quarter, 87% had that change be a markup. And that's the second highest positive rate that we've ever seen on the platform, trailing just slightly behind the second quarter of this year. So the activity rate was about 11.3% of the 4,900 startups that we tracked for this data raised around or exited in the third quarter. And you know, that rate of deals it was slightly higher in the second quarter at 12% versus 11.3% in the third quarter. But again, you know, the story here is that rates both for the frequency of fundraising it's elevated historically, and then the tenor of that fundraising is extremely positive. So I think it indicates that we have a marketplace where there are plenty of founders who are looking to raise money and plenty of investors willing to fund them, which is a huge turnaround, I think, from the second quarter of last year. I don't know if Andrew or Bo, you have any more kind of comments on this, what we're calling an ongoing surge.
Yeah, my one comment, and this was actually a surprise to me. This comes from another our later stage markets report that we do at SVB, is a lot of what's been leading the turnaround and surging this quarter. They're the obvious sectors: fintech, life sciences, things going on there, but consumer, like the elasticity of consumer, and we're going to get into the payroll data and whatnot in a moment, has been amazing. So it's been incredible to see consumer companies, D2C, I mean, in every sense of that sector, those entities throwing a lot in the payroll, which we'll get into. Supply chain challenges, yes, are upon us. So I'm going to be curious to see what that does to the consumer sector. But it's interesting to see, like, I think that probably led a lot of the downturn in negative activity, the blip that you maybe see earlier in the chart. I think it's leading a lot of that positive activity now. So that was one thing that was like very intriguing to me in looking at some of the underlying data behind all these things. Bo, I don't know if you have anything to add to that in terms of what we're seeing drive positive markups in the ecosystem.
Yeah, I'm also seeing a lot more kind of acqui-hire acquisitions happen too, as teams are trying to grow in more pod-like, encapsulated structure. So it's easier to hire an entire team of engineers, designers, product managers that know each other than it is to group them one by one. So we are definitely seeing, in addition to markups, more acqui-hire activity as well.
Yeah, great point. Talent is huge right now, as we'll get into. Let's head to the next slide and look at some of the kind of valuations and where things are at.
So this chart now, the stages are going left to right. So pre-seed, seed, Series A, Series B, and then the bars on each stage, time is going left to right within those bars. So the third quarter, the data that we're talking about today, it's the rightmost bar on each stage. It's the rightmost kind of gold-colored bar. And so as you can see, like what you would expect is that obviously valuations increase from round to round, but really what we're looking for here is the change over time. So the way that the different colored bars within a round have changed over time. And in general, I think the effect that you see is in fact, of course, an increase in average valuations. Those you can see the pre-seed valuations that's about an increase of about 14%. Series A valuations increased almost 20%. Series C, our average valuation that we're tracking on Angelus decreased. I should say that these are average values, which make them, very prone to skew from outliers, particularly for the late stages where we may only have, a handful of Series D deals in a given quarter. So I'm not sure I would read too much into the changes in valuation at the later stage. And we are going to actually discuss on the next slide, we're actually going to show some median valuations which are more robust. Thank you. So what we see here are a kind of a more robust measure of of the current slice of valuations that we're seeing on the Angelus platform. So, I think this is very helpful for all those founders in the audience who are thinking about kind of where their startup is tracking relative to kind of market norms. These are kind of the new market norms that were established in the third quarter, pre-seed through Series B. So, some really remarkable numbers there. Certainly $200 million pre-money valuation for Series B startups is a new high for sure. And then also kind of the increase that we've seen in just seed valuations. That number, that $15 million number used to be 12 million at the start of this year. So a real increase in the median valuations that we're seeing kind of across the board. I'm wondering if the SVB folks have any more kind of insights into the valuation upticks that we're seeing kind of in general. And I think you see this as well in terms of like what we used to call pre-seed is the new seed. And we definitely see that in terms of the valuations here. If you go back and rewind the Angelus data 4 or 5 years, and I showed you, what round has a median valuation of $8 million, you would say that you would call that the seed round. Now that's very firmly the pre-seed round in our data. And I'm wondering if SVB folks have seen kind of something similar in terms of the early fundraising and increases in valuations kind of across the board, both in early and in late.
Oh, thoughts? I have many.
Yeah, I think one of the factors of these valuations going up are also just the rise of mega seed funds. Like a lot of traditional Sand Hill Road funds are now raising, sizes of up to 500 million seed funds. So these seed checks are at higher valuations and also larger sizes up to, it's an anomaly, but it's also not uncommon to see like a $20 million seed check at this stage. So I think there's just like a lot of macro forces in terms of even fund size that's, inflating and increasing the valuations over time.
Yeah, totally agree. I mean, you think about these $400 or $500, $600 million seed funds that the Sequoias, the Greylocks, the Andreessens are raising, and putting on a VC perspective hat. So I was in the VC world prior to this. You still want to deploy that in 2 to 3 years, right? You still only have so much appetite as an individual partner at a firm for how many deals you can see and execute on. And so in many ways, the only way to do this and do this efficiently is you can only do so many deals. So you maybe still only going to be able to efficiently do 10 to 15 deals per partner. You're only one person. B, you still want to deploy that capital in 3 years. And so what happens, right? Taking a macroeconomic view here, those round sizes must go up, right? Because you're fighting with more capital for the same amount of deals. So that's one factor at play here, Abe, I think that influences it. We no doubt have, I know there's some questions in the chat around like sectors that are driving this. So there are certain sectors that are being valued higher than others and that are driving this faster than we've ever seen before. Let's take fintech as one example. Now, more at the Series A or B stage, the average fintech company is now being valued at around 25x their revenues. I want to pause and like let the significance of that come in. If you're an account executive, right, at a Series B or A fintech firm with a quota of $1 million, you're adding $25 million of valuation to your company every year on average. And these companies are figuring out how to monetize and scale quicker too, in the face of those competitive checks coming their way. So that's just further fuel on the fire are the valuations for fintech. Enterprise, that's about 20x. Consumer, that's getting closer to 15, 18x. But to Abe's point, right, these rounds that looked like different rounds 10 years ago, those multiples were 8 to 12x. And so that's a really, really big deal. Public markets pull all of this up too, right? They are favoring and valuing tech companies, especially coming out of the pandemic, very, very highly. So I think those are all things that influence the median valuations here, but there's just so much capital in the ecosystem that's trying to flow to still a limited number of deals. And so when you look at the supply and demand of it, if we're going to be kind of nerdy and look at the macroeconomics of it, that's going to drive this pretty heavily. It's very interesting to see. Do you want to head to the next slide, Abe? Awesome. There
was a question I saw asked in the chat around, if pre-seed is the new seed. Is seed the new Series A? And I think this chart actually helps to really kind of answer that question or provide a little bit more perspective on that. There is still a difference in terms of fundraising instrument between that distinguishes kind of pre-seed or seed from Series A, although we are seeing an increasing number of seed rounds that happen on priced equity. And so I think there is sort of the rise of a kind of, I think there is a sort of gap that's being filled here where folks raise, maybe they've done a pre-seed round, they raise a price equity for a larger seed round, but it does not involve a professional venture capitalist taking a board seat. And so I think there is some interesting, there is a little bit of a dynamic here that you see in that about 28% of seed deals that we saw in AngelList in the third quarter that did a priced equity round for their seed. Maybe there is the rise of kind of a little bit of a tweener kind of, seed is the new Series A, but you can really see there's sort of a qualitative difference between a seed or pre-seed and a Series A, right? Series A's are almost certainly it's a priced equity round. And frankly, a lot of the rounds that we probably have tagged as safe are probably like, in conjunction with or immediately prior to a Series A. So like Series A is going to be priced equity. An increasing number of seed deals are priced equity, but there's still more than half, actually more than 2/3 are being done on safes. The other thing that you see here that I think has been pretty constant over the last few years is that at least as far as AngelList data slice is concerned, for fundraising, safes have entirely replaced or almost entirely replaced convertible notes for fundraising, right? The safe is a very, it's a lightweight, attractive instrument that has a lot of benefits. It's something that has definitely taken over early stage fundraising. It has a lot of benefits, and I think it's sort of become, now that I think both founders and investors are very familiar with it, it has really taken over for early stage fundraising.
It's an interesting thing to think about here, Abe, is also price rounds are on the rise over safes. Okay, in one sense, there are bigger checks being cut and bigger firms getting involved, and they like to do price rounds and sit on the board and have that all kind of teed up. So that's forcing that to happen. In another sense, given the competition, safe notes and speed and executing on deals really quickly might force that to kind of go up over the next 2 quarters. So I'll be interested when we do this report next quarter and the quarter after to see how that yo-yos back and forth, because one is with great size of deal, there comes some responsibility to price it and do all the things that you do with that price equity round. But on the flip side, with the speed and execution and competition right now, the safe note structure oftentimes makes more sense. Somebody asked about geographic splits here. I don't suppose we have any, if we know if one instrument's more popular on East Coast versus West Coast, or how that's working, or new and emerging geos. Do we have that data by any chance?
No, so I know, just to speak to kind of any geographical split within AngelList data, like our data in our startups is, I would say, very strongly biased towards, West Coast Silicon Valley startups, plus I would say a number of startups in emerging hubs like Denver, Austin, Miami, Seattle. I would say we're probably New York is also the second largest, of course. I know you all are both in New York. I would say a lot of more traditional deals that might come through an angel network are not really represented on our platform. And I do know, just looking at kind of the Angel Capital Association summary statistics, that a lot more of those deals, like a lot fewer of those deals, are done on safes versus what we see. So I think what we see at AngelList is like a very particular slice of what could be considered kind of early stage deal flow, what we consider to be kind of like venture backable early stage deal flow. That's not to say that every pre-seed deal on the platform has is led by a professional venture capitalist, but I would, kind of the standard or typical company on AngelList is one that, could raise a Series A from a professional venture capitalist in some, version of the future. So I would say that in geographies that are maybe less hot from a venture perspective, I would expect to see actually more convertible notes, fewer safes. But this is kind of the slice that we have at AngelList and what's on the platform.
Here's a question for both of you that somebody asked that I love. Nobody knows the exact answer, but I want to hear opinions. When's the music going to stop? Right? When are these valuations going to continue to increase and the rounds going to continue to go up in the trajectory we're seeing? Any thoughts or theories on if this is sustainable and how long it will sustain? I have one opinion here, but I'll defer to both of you.
So, my kind of macro perspective on it is that my belief is that the real enemy of early stage financing are interest rates. So I think it'll be a function of interest rates. And I think, I remember when we were fundraising for the first company I founded, we definitely had investors for whom, the idea that, hey, if we have to make any kind of return, we have to put our money at risk. And investing in, these guys at Berkeley seems like a better deal than, we could put more money in the stock market, or we could invest in these guys at Berkeley. So like, sure, this seems like a reasonable trade-off. I think if we had some investors that, if they could make 5% risk-free in a bank account, they would not have put money into our company. And so that, and I know there are also some kind of like financial reasons around discounted cash flow and the fact that you're illiquid for a very long time when you do early stage investing that makes early stage startups very sensitive to interest rates. But to me, I think there's also like an investor psychology perspective that like, can you make return in a risk-free way? And for such a long time, for the last decade, the answer has been no. Will that change in the future? I'm not sure, but I would say it's mostly like interest rates and actually kind of real interest rates that I think are the big driving factor on the early stage ecosystem.
Love that. Bo?
I think that, when we're thinking about like new fund differentiation techniques, like the biggest catalyst for what feels really unsustainable are, more multi-stage hedge fund, private equity funds moving into direct investment. So the Tigers and Coatus of the world have really introduced a whole new kind of approach to startups that are essentially indexing early stage companies and just making directionally correct bets across high volume deals. And I think that's really put a lot of pressure on other firms to follow suit. So the question, the kind of existential question is like, if everyone starts copying the Tigers and Coatus of the world, will the sustainability, piece start to come into play? Just because differentiation is always going to be pressuring people to try new things. And once that this is a copyable strategy, like perhaps we will hit a more of an equilibrium in terms of valuations and pacing of deals. But that's, still to be determined.
I love it. One kind of macroeconomic and one microeconomic view.
And my own perspective on what this report will look like in future quarters is that, like, I think we'll actually see what we saw in the change between second quarter and third quarter, which is just like, I would expect our fourth quarter numbers to be, just a little bit worse than our third quarter numbers. And then our, the first quarter numbers next year to be a little bit worse than that. And that does not mean that those numbers are like, there is plenty of room actually, because the second quarter numbers were so strong. A huge number of companies raised money, and also, a huge fraction of those were markups. I think there's like a lot of space for those numbers to kind of be pulled back more towards typical historical values. So, I'm not sure if kind of the where we're at is I think there's kind of a gentle kind of glide pattern in terms of pulling back to historical numbers that does not involve some kind of like catastrophic crash or something in terms of early stage valuations. And that honestly, I think that's probably the most likely outcome. I would be very surprised if, any quarter in the next several quarters managed to top the second quarter of this year, because I think there was a lot of pent up deal making energy that went into the second quarter this year. And I think we have a lot of room to pull back to get back to historical typical values that we've seen over the past decade.
Yeah, the one thing I'll add is to your theory, Abe, of we're going to glide back down to earth, not crash and burn in the atmosphere, or maybe that will happen, hopefully not. you have these huge funds that raised this year, still on a traditional fund structure. They're not using the rolling fund structure where they're refreshing every quarter. And that is in theory meant to last 2 or 3 years. And so I do think the music won't stop for those huge funds who have raised the mega funds and their deployment over 2 to 3 years. The one thing I always say for the founders who are raising on the line, thinking about raising this quarter, go to the funds who have just raised fresh capital, not the ones who raised 3 or 4 years ago, because they have a mandate to deploy quickly and put up numbers. So I think we got another couple of years, at least with this latest batch of massive funds. But I agree, it'll probably be a glide back to earth on some of these numbers, if that happens at all.
And there may be a more, speaking about kind of fundraising on those venture funds, is that there may also be kind of there may be a macro shift in terms of the way that large LPs allocate towards venture capital and private equity, just based on some of the really insane results that came out on, for instance, university endowments over the past year. Some university endowments with 50% returns, largely driven by private equity and venture capital. If that, that numbers that are that eye-popping may actually create, for instance, a large LP might go from a 20% allocation in private equity to a 30% or a 40% to a 60% under a kind of actually like a change in thinking about the way that they allocate capital. And those can help to sort of sustain things that look unsustainable if they're reflecting of a real kind of shift in terms of the way capital is being allocated. Really exciting stuff. I know we have, so this is the AngelList data. I was delighted to share it with all of you. And now I think we can go for the SVB contribution, which is the spend data on the really huge number of startups that you all work with. Really exciting summary statistics here.
Awesome. Thanks, Abe. And we'll keep up the pace here. I appreciate the questions too. We wanted to layer them throughout. So we're going to get into some SVB data now. We looked at primarily 3 sectors, which I think feeds into a lot of what Abe said in some of our current commentary. We looked at consumer, enterprise, and fintech for the following slides. And so I'd say let's dive right into it if we want to head to the next slide. I'm surprised by consumer and consumers' activity coming out of the pandemic. It's a little small on my screen, but I have the details here. So basically, what are we looking at here with this payroll index? I want to explain this because this is important. We're looking at the one on the left-hand side. That is the benchmark across all companies. If you look at how it progresses upwards, basically what we're saying is Q3 here in 2021, on average, these companies increase their payroll median spend by about 79%. Let's take that in for a second. That is a really, really massive increase. And of course, you see the dip there right in Q1. That's not to say the world stopped completely and we stopped investing in headcount and growing these companies, but it certainly slowed down. And I think it slowed down probably the most for consumer as we all went home, as supply chains changed, as we were just not quite so sure what was going to happen with this sector. But in my personal opinion, and I want to throw it to Bo for her thoughts on what we're seeing in consumer, here's the most amazing thing, in fact, I've said to founders I advise here. You basically saw your total addressable market for a lot of these consumer products instantly change overnight, right? If we think about certain demographics that weren't used to ordering D2C goods, right? Or had never ordered things online from certain retailers and providers, and now they're stuck at home in the pandemic and they're going to do that. Well, not only did they do that, but they're not going to go back, right? They've enjoyed purchasing those consumer products, interacting with those consumer companies. A lot of the healthcare stuff goes into this as well. And so, again, it's been very elastic. We saw that drop off at the beginning of the pandemic, but now these companies are eager to hire and spend on payroll. To Bo's point, they're making acqui-hire acquisitions to feed this, and it's been really interesting. But Bo, what other insights would you add to what we're seeing in consumer, especially subsectors of consumer that we have seen thrive?
Yeah, I think what's really impressive about consumer is just how responsive that sector became with at-home trends and anti-cyclical trends once people went into lockdown. We definitely saw a huge rise in spending across different at-home trend sectors like gaming, wellness, e-commerce. And we're also seeing just general, consumer consumerized products within healthcare and as well as fintech. I think what's really impressive is just from an e-commerce standpoint, like the boost in sales that happened in 2020 was 27% higher than what happened in 2019. So even though, we look back at the pandemic, like consumer companies were the hardest hit in terms of they had to cut down on spend early on in Q1 of 2020. They definitely have also rebounded the most out of all the other sectors compared to fintech and enterprise.
Awesome. Abe, anything you'd add to that on things that you've seen in consumer from your end at all?
Just anecdotally, we're seeing the D2C brands I think are really interesting. A number of them have come through the Angelus platform recently, just kind of looking at those. And I think you're right, Andrew, your point about the addressable market of those companies expanding during the pandemic is I think exactly spot on for what's happening.
Awesome. A couple questions I'll answer. So folks who are saying, how do I find information on funds, either investing in these sectors or elsewhere, fresh funds? Well, first and foremost, AngelList has a lot of great data on their site, especially around the rolling funds and who's investing at the early stage. But there are a lot of other notable sources out there for maybe the later stage stuff, PitchBook, Crunchbase, and whatnot. But I would start with AngelList and maybe drop Abe a note to see what kind of data they have on recent funds who have raised. So I wanted to address that question. Let's dive into the next slide. So enterprise, my personal favorite because I come from the enterprise world, so I'll be biased here, but really interesting time for enterprise during the pandemic as well. Slashed a lot of spending, right? Spending and headcount in the second quarter of last year. I think that a lot of enterprise companies I met, by the way, maybe cut a little bit too close to the nerve and the bone and laying off folks. And then they're like, oh my God, wait. Actually, a lot of these companies that went home overnight, they need enterprise software. I'll use SVB as an example. I mean, you have no idea how complex it is to take a bank, a regulated bank, and move them home overnight to do their operations. There's all sorts of enterprise solutions and technology that certainly we took on and many others. And so again, you saw that dip and you saw that bounce back. I think the other interesting thing about enterprise though is a little more flexible in terms of margins than consumer, where there's hard goods and hardware involved. And so maybe that payroll spend was displaced and they said, you know what, we can outsource or we can do some other things over here to make our business a little bit more efficient. So that's just a guess and a hypothesis as to why you didn't see it snap back as much as consumer. You didn't see the drop off and snap back as much. But certainly enterprise survived and did quite well throughout the pandemic as well. I know, Bo, you have more thoughts on enterprise, maybe subsectors that did well here.
Yeah, I mean, I think, again, like the pandemic accelerated a lot of innovation within collaboration tools, cybersecurity, as we start to see the workplace become more hybridized. So we're also seeing enterprise companies increase, to Andrew's point, valuation up to 20x their sales. So there's a huge competition right now in terms of hiring for sales and tech talent within the enterprise sector.
Awesome. Let's jump to fintech. So fintech, very interesting. Probably seeing the most recent surge across many metrics and certainly heavy in payroll. We saw the payroll index and spend increase 45%. 45% right this past quarter. And that is huge. Fun fact for everybody, at least I think it's fun. About 1 in every 5 venture dollars are going into fintech right now in many of the main geos. Certainly here in New York, it's become a center for fintech, blockchain, crypto. You're just seeing an immense amount of capital being poured in here. Perhaps the quickest accelerating sector by many metrics that we've been keeping an eye on, and most definitely in New York. So incredible quarter for them in terms of hiring, growing. Some of the fastest growing unicorns I've seen, just going anecdotally by the headlines, have been fintech companies getting to $1 or $2 billion valuations in 1 or 2 years. Crazy, mind-blowing. To the question of whether it's sustainable or not, I don't know. It's really, really interesting to see. But Bo and or Abe, other thoughts on what's happening with fintech right now to increase this spend?
Yeah, I think what's really exciting about fintech is just the boom of new business models at the epicenter of traditional financial services, crypto, Web3, DeFi, and we're seeing more of these newer business model of fintech companies raise money in non-traditional ways with DAOs and tokens, in addition to institutional VC money. We're also seeing, just like because of the pandemic, the whole consumerization of products, like more verticals within fintech to really serve new user sectors and under served markets, more consumerized types of products within DeFi, as well as even the traditional fintech financial services have had to accelerate their product innovation too during this time, just because people are spending more time on their phones. They're thinking more about at home, investment management, and very much being their own self-taught investor and wealth manager.
And I would be remiss if I didn't add, also new business models on the B2B side, or at least accelerated business models on the B2B side. A great example of that, is Pipe, Angelus partner on the Stack product, and thinking about how you can draw together financing in really interesting ways. I think it's a really exciting sector, and one that I think Angelus is actually probably overweighted on. So it's been exciting to see that data.
Let's head to the next slide. So this is really interesting. I'll give my kind of interpretation of what's going on here and what we're looking at. Basically, what you've seen is that of the overall spend on talent and whatnot, payroll is actually, as a proportion, decreased a little bit, in outsourcing, recruiting and outsourcing are kind of yo-yoing back and forth here. And so the interesting thing, right, that you saw is at the beginning of the pandemic, outsourcing increases more than recruiting. What does that mean? We're hiring part-time folks. We're hiring, consultants. We're hiring folks that can maybe pick up bits and pieces of what we're doing, but we can't afford to have as many folks on full-time. Now, especially with the resignation, as I keep referring to it, August was a record month for people quitting their jobs. 4.3 million people just straight up quitting their jobs. And so it's a heavy time for recruiting and recruiting that talent and putting spend towards recruiting. And so I think there are a lot of vendors and service providers that are very, very, very busy out there, lawyers, bankers, and whatnot, the folks that are at the crossroads of this ecosystem, none more so perhaps than recruiters right now with everything that's going on. The other thing I'll say, so this has also been a boom for what I'd call probably hybrid or remote tech and marketplaces. Groups like Upwork, Fiverr, we've seen a lot of spend on them for consultants. There are plenty of, I won't name too many by names, but there are plenty of like technology solutions, we'll get into tech in a moment, that folks have kind of adopted where they can enable their workforce remotely and maybe get more out of less. So it's a really interesting time for how do we have full-time employees versus part-time employees? What do we put towards outsourcing that talent versus recruiting that talent? We've seen swings back and forth there as well. Let's dive into the next slide. I want to leave some time for questions at the end here and keep the questions coming. So I love this. I know there's a lot of logos here, but what were startups spending money on tech-wise over the last few quarters? You'll notice in this kind of map and see some interesting things. Uber, spent a lot of money on Uber right before the pandemic. Completely falls off the radar. That kind of makes sense. Liz on our team did an amazing job condensing a lot of credit card data and looking at. You've seen the travel spend on SVB credit cards up, drop completely off during the pandemic, recovering nicely now. So that's really, really interesting to see. As should be obvious, right? Zoom increasing, right? And kind of leveling to the top 5 of solutions that folks are spending. So it's really intriguing to see these things going up and down. I'm going to mention some things that I think have been really, really interesting that aren't necessarily on this chart. Google Ads, right? I like seeing some of the changes there as well as we try to think about how we're maybe not meeting folks in person, but advertising to them digitally. You might have embraced digital advertising for the first time. Solutions like Envoy, which we use, right? Now you have folks logging into various offices remotely, and you're trying to keep track of your workforce. That's had a really, really good year. I know Bo has some as well, so I won't mention those. There are a lot of remote technology provisioning companies that have done well. I think about like First Base, which is an entity I like that, hey, now that you have workforces distributed everywhere and they're getting onboarded virtually, think about how many of us have started a new job virtually. Bo, you're kind of lucky. We're just back in office now, but you almost started virtually. You have all sorts of tech to kind of help folks ramp up virtually as well. So it's really interesting to see how this map has changed. But Bo, any other thoughts on like technology solutions and where we've seen spend change here?
Yeah, one notable shift is obviously just the remote work from home patterns and how that has really necessitated a lot more encryption products within the tech stack for company accessing remote access into databases, as well as thinking more around cybersecurity, data privacy. So I think that's where spend has increased, as well as people moving away, to remote locations. So you're spending more around cloud computing, edge computing, storage. You're not close to the servers as fast, as an employee, or your company has, migrated elsewhere. So it's really important to kind of catalyze the power of edge computing and being able to get data and computation way faster and cheaper.
Abe, thoughts or predictions on tech that's on the rise or falling off the radar?
This is such a cool chart. I just wanted to commend the SVB team for making this. I think it's like looking at like the Uber versus Zoom, like you can exactly pinpoint the pandemic, and you also know that the second quarter is when taxes are due. So it's really cool to see this really, really awesome, great use of data, great visualization. Yeah, I think a lot of the collaboration tools, that's become a really hot sector that we're seeing on AngelList, like obviously things like Notion. I think it might be a little bit more time before we see Notion on this chart, but maybe not too much longer. I know that's something it's really, at AngelList, now that we're kind of a remote first company, it's something that we've spent a lot more with and spent a lot more time on.
Awesome. And I would be remiss if I didn't say one little plug for SVB. We have discounts and partnerships with many of these folks. Feel free to get in touch if you're a customer or you're interested in that. We can hopefully hook you up. Let's head to the next slide and kind of our last data-driven story we want to tell today, and then we'll answer any questions and wrap up. But we also did a spotlight on New York for this report, where Bo and I sit. We care about startups everywhere, but we happen to sit in New York and cover the New York sector closely. And I'll just say, as a New Yorker now, of the last 10 years and getting out here during the pandemic, you got to kind of be proud of the comeback story here of going from New York is dead, center of the pandemic in many ways in early months, to just a really, really passionate resurgence here. I want to talk a little bit about what we saw that drove that. So first of all, you saw some curious things. I remember the headlines last August about companies not actually quite leaving New York fully and instead doubling down on real estate here. I think the first big splashy headline was Facebook actually taking out a lease. I think it was around 750,000 square feet in the old post office right across from Penn Station. That's a really big deal, right, for them to double down on that. And certainly Google, Amazon, Apple following suit with some really big leases here. I think the space that they took up, I'm not a real estate broker. I'm better at the banking stuff, but the note I have here is about 1.6 million square feet. That's really huge. So you saw these signals of companies not quite leaving. New York just also happened to be a haven for a lot of the solutions that benefited from the pandemic. There's quietly been a big healthcare and life sciences boom going on in New York, and certainly a lot of those entities benefited from the pandemic early on. Fintech has been a long time coming here, as you know, as I saw somebody say, the capital, right? So much of this town is fintech, and so much of that had to be put into play, again, to some of my points earlier, as banks went home overnight. It's just really incredible to see all this happening, and the numbers don't lie. So if you look at this past quarter in New York, there was about $13.5 billion, at least by one count I saw, VC money that went into New York City. If you look at all of last year, it's by many counts somewhere around 20 billion, 15 billion, somewhere in that range. That's kind of a wide range. But what I mean by this is you basically have a quarter that could have matched all of last year. And if you look at this last quarter, it's 30x what we saw in the entire year 10 years ago. 30x, right? And so as we go back to Abe's slides on why are the valuations going up, what's happening? I mean, this is a lot of money still fighting over fixed deals happening here in New York. So it's really, really incredible to see. The last thing that I like, and Bo, would love to hear your commentary in New York as somebody plugged into the ecosystem here, is used to be heavily thought of as an ad tech town. I mean, that was naturally one of the first tech or industries that tech disrupted. And then we kind of broadly got into consumer and enterprise and had a lot of great exits there. A lot of those founders are diversifying further. So not only have those founders become angels in the new crop of businesses, the founders and folks behind, the Datadogs of the world, the MongoDBs, the Pelotons, the Warby Parkers, and on and on. But they're not going and then starting those same companies over and over again. You've seen ad tech entrepreneurs start healthcare companies. We've seen infrastructure and B2B SaaS entrepreneurs start fintech companies. And so it's continuing to diversify. 1 in 5 dollars going to fintech. I saw another stat that was 1 in 5 going into life sciences and healthcare. So there's your makeup of a lot of heavy businesses that are attracting attention here in New York. I'll get off my New York stool for a second. Bo, any thoughts from you on what's happening here as we wrap up?
Yeah, so I actually moved to New York from San Francisco 5 years ago. And at that juncture, when I moved, I realized that there was less maturity around an ecosystem of angel investors, as well as just a lineage of product managers and people who had been trained in larger product-driven orgs. I think flash forward in 5 years, I'm seeing a huge shift in terms of there's a lot more angel activities happening thanks to the liquidation events from, the MongoDBs, the Rent the Runways, the new IPO exited field of founders who are also opening up shop on AngelList and doing rolling funds and finding, creative ways of leveraging that their new wealth and helping the next generation of founders. We think, definitely the fintech world is a great intersection of what New York has traditionally been known for in the financial services with technology. And so much of the pendulum and swing from west to east, as NFT week showed. This is New York is starting to be the epicenter of events happening. So yeah, we're very excited for a booming 2021 moving into 2022. And yeah, let's get wrapped up shortly. I know we're for the sake of time.
Abe, we want you to come to New York. We'll do this.
Yeah,
live.
come on,
You're
Abe.
on the West Coast.
For the next quarterly review, let's do it live.
Yeah. So let's head.
Cold. I don't know.
Let's head to our last slides here. I know we answered a lot of these questions. I know we did not get to all of them. We opted to answer throughout rather than at the end here. But feel free to follow us on Twitter, connect with us on LinkedIn, shoot us an email. We are happy to try and answer your questions where we can. I'm going to throw it back to Bo to round this out here.
Yeah, and one of the key information sources that we do want to share with you is the founder playbook on the SVB website, where you're going to be able to find the video recording of this event, as well as the quarterly early stage venture report that we put out. We also want to, let you know that this is going to be an ongoing series. We'll be publishing new reports in conjunction with AngelList on a quarterly basis. And we also release our own state of the market reports, leveraging SVB transaction data. So all of that can be found on the svb.com/founders-playlist.com, -playlist. And you'll also be able to access Andrew's playlist. These are audio clips of fundraising strategies, ways to find your advisor, and getting a little bit more hands-on support from us. Thank you so much for tuning in. Hope to see you on the interwebs, guys.
Abe, thank you for joining us. Thanks so much to AngelList as well for collaborating with us.
This is an exciting partnership, and yeah, looking forward to doing this in future quarters as well. That's really two really great data sources to be able to share with folks.
Cool. Have a good one, everybody. We'll see you
All
soon.
right, take care.